Okay, today we're going to be dealing with retirement income planning. And just to remind you of where this fits into our process, we've got 5 steps that are critical to building a successful retirement plan. We've gone through 4 of these already, but we've got the retirement planning aspect of it, really, the cash flow review, then there's the risk management, then there's the tax planning. You've got to make that more efficient and help save money where we can. But then we get to investment management. In investment management, we push this position as being last because in many ways it's the most important because it's supportive. It plays the supportive role in making sure that your key goals are going to be met. So, your investment goal, investment strategy, was to develop a portfolio structure that was going to support what you want to do. Now, we've made a few assumptions in this retirement plan. One of those, of course, is the expected rate of return. We work with you to develop kind of your risk and reward trade-off, and based on that, you said you were going to be comfortable with an allocation of roughly 60% to stocks, broadly speaking, 40% to bonds. This would allow you to expect to generate an average annual return about 7.3% per year. Now, that's a target, that's an average. This also reflects what your goals are, and it means it's successful. It does work. This is going to provide sufficiently for your retirement, your cash flow, and the legacy goals that you have. So everything's in alignment. That's great. But now we've got to kind of implement that and flesh out what's the investment strategy that actually allows you to achieve this 7.3% average, which supports your retirement plan and your goals. We do this by looking at the appropriate investment categories. We don't want to look at ones that are faddish. We want to look at ones that have essentially a long enough track record to be predictable. They're statistically significant, to use a buzzword. It means over a long enough period of time, we can tell you what large cap growth stocks, large cap value stocks, small capitalization stocks, real estate, international, what they're going to earn, how much they're going to be varying from that average, and we know how to mix those together. The same things on the bond side. We're looking at long-term bonds, short-term bonds, and then, of course, cash equivalents. This predictability is critical because by knowing what the individual categories can do and how we mix them together, we can know what that mix, what that allocation will do. There's a predictable goal. We're not talking to you about conservative or moderate or aggressive. We're literally saying we think the legitimate goal here, given this allocation, given your comfort factor, is going to be 7.3% per year. That's predictability. It also then allows for accountability because there's a goal against which performance can be measured. As we look at your portfolio right now, the current allocation does not match your tolerance or your cash flow needs. So here's the breakdown of where you are. Right now, you've got 79% in U.S. stocks, 10% in international, 2% further international in emerging markets. Then you've got about let's call it 1% in real estate, 4% in U.S. bonds. Actually, some of the other also represent U.S. bonds as well. But you've got very little in some categories and a lot in others. This essentially is about a 92% allocation to broad stocks, 7% to long-term bonds, 0% to short-term bonds, and 1% to cash equivalents. Now, your desired allocation, again, this came from taking you through what that risk-reward spectrum looked like and helping you to figure out where you were going to be comfortable. And you, again, opted for something where it's 60% broad bonds, which meant we're going to be 60% in broad stocks, 19% in long-term bonds, another 19% in short-term bonds, and I'll deal with that a little bit later, and then 2% in cash allocation. Now, what's the difference between these? Well, the target goal, as we know from the plan, is 7.3%. The target return for your current allocation is about 9.2%. The average amount of volatility for your desired plan would be roughly 11%, whereas the average volatility for your current plan is 18%. Now, what that means is that for most of the time, if you think about, let's say, a 10-year period, roughly 7 of those years, you're going to have an annual performance of somewhere between whatever the target is, plus that volatility, or minus that volatility. So let's take a look at your desired plan. That'd be 7 around it. 7% plus 11, 7% minus 11. That's most of the time. That's 7 out of 10 years, if you will. The current allocation that you've actually got is going to be 9% plus 18, or 9% minus 18, again, over those roughly 7 out of 10 years. If we go to the tails, though, kind of a bell curve we all learned about in high school, and we go way out to the tails, let's say 4 times in 100 years, what does this experience look like? Well, based on what we took you through, your desired portfolio, you're kind of saying to us, look, at 22 minus 22%, I'm getting a little nervous. I don't know that I can tolerate that. On $1 million, that would be, you wake up some December 31st, you've lost $220,000, and we're saying you need to stay with it. You don't want to bail on this. You got to stay with it. This is part and parcel. This is the cost, if you will, of earning 7% average annual rate of return. Your current allocation is going to expose you, and Lord willing, you live long enough, you're going to be down 38% some December 31st. That's $380,000 off on $1 million. That's more than an extra 100 grand of what you'd be missing. That's just not going to be sustainable to you. It exposes you to greater downside risk. Yes, it's a higher rate of return, but that comes with the price that you're not willing to pay. And I know that's a subjective decision you made on your part, but you need to listen to that, because everyone's going to make decisions as they go forward based on both their head and their heart. And when the times get really, really tough, too often, if you've violated your risk threshold, you're going to bail. You'll bail exactly the wrong time. The other problem with this is it just doesn't provide sufficient cash flow protection for you. The other thing that we've noticed is that your current allocation is attempting to time the markets. You mentioned in your conversation that your current broker is moving between asset categories and market sectors based on his reading of the economy, kind of his crystal ball. So here's a breakdown of your domestic equity holdings by capitalization, that means size, and valuation, that means orientation. Is it a growth orientation or it's a value orientation? Notice how skewed you are. We put the average, like with a dot, right in the middle of the upper section, but you're basically looking at like 8%, 74%, 10%, very high up here in large cap, and it's kind of leaning from a blend to a growth perspective. If that's what you had picked, and if that's what you stayed with, this wouldn't be an issue. But one, it's not what you picked, and two, you've told us that this isn't what it's going to be tomorrow. Well, it's not necessarily what it was yesterday. It's what it is today, but your broker is trying to be here sometimes and be someplace other times. He's trying to move up and down within this square based, again, on his crystal ball. We can look at it another way. Here's the breakdown of your domestic equity based on sector allocations, and I'm comparing it with the S&P 500 because that's a very, very broad and standard index of what the 500 largest publicly traded companies look like. So notice that your portfolio is much higher in some categories, consumer cyclicals, much lower, say in technology, than what the S&P 500 would expose you to. And again, this is not something that you're sticking with. This is something that is going to change. Would have been different yesterday. It's probably going to be different tomorrow because your broker is going to try to move back and forth between based on his crystal ball. So what's the problem with that? It doesn't work. The problem with market timing has always been it fails to deliver the promise of we can figure out what the future will be and be there in time to reap the reward. So you've probably seen a chart like this before. It breaks down the market. In this case, we chose the S&P 500 by all the sectors. And as you can see from the index below, we've got consumer discretionary index, consumer staples index, the energy, financials, healthcare, et cetera. And they've been given a color code. And the reason for the color code is so that you can see within the S&P 500 from 2010 all the way through basically year to date here in 2025. What these sectors have done, and let's just take the red, or the utility. Notice that in 2011, it's right up near the top. 2012, it's down right here in the bottom. Okay? It moves up a little bit in 2013, 2014, then it's back down, etc. You can, I'll move the cursor out of the way right now, but you can pick any one of those colors, and I'll just stay here for a minute. But you can see there's no predictability to this. There's no sense of being able to say, look, utilities are going to be strong for a long time. Consumer durables will be strong for a long time. Financials will be strong for a long time. And the same thing I could show you if it was U.S. large cap growth or U.S. large cap value, or if it was small cap, whatever. You're not going to be able to figure out which category or which market sector is the leader. And if you're trying to play that and look at that crystal ball, you're ultimately going to fail. The other problem is that your portfolio has increased your securities risk. Concentrations in individual stock expose you both to the risk of stocks in general, which you have to accept if you're going to have any sort of allocation. That's okay. But they also are exposing you to the extra risk inherent in individual stock. Now, in your case, 57% of your portfolio is in one stock, Amazon. The problem with that is the portfolio no longer reflects protected diversification. It also reflects the fortunes and the losses of one company in one market sector. I've grabbed a chart, what that performance looks like for Amazon over the last 5 years. And you can see a lot of down and a lot of up. Chart doesn't necessarily give you as much perspective as the numbers that we've written down at the bottom, so you can understand. From November of 2021 through December of 2022, it was a 54% drop in Amazon. And then again, you had a 28% drop from January of 2025 through April of 2025. Now, I'm not here arguing that, oh, that's bad, you shouldn't own Amazon. The point that this is not bad volatility or inordinate volatility for any one stock. It just shouldn't be the volatility for an entire portfolio during retirement. And when you've got 57% of your portfolio in one stock, as I've said earlier, your portfolio is no longer diversified. You're not getting that protection, not getting that benefit. Your portfolio is overwhelmingly now being determined by this one company. And over the same 5-year period of time, your portfolio, because of this one stock, has lagged the industry and or the index. You see, there's a comparison of what Amazon has done 1 week, 3 months, 1 month, 3 months, year to date, 1 year, 3 years, 5 years, compared with the industry and compared with the broader index. Over 5 years, average annual return would have been 9%, which doesn't sound bad. But again, you've had to put up with these broad, huge swings. And if you had been allocated 100% to the S&P 500, you'd have still gotten about that same volatility in a certain sense, but you'd have reaped a 15% reward. So you're paying the price of the extra volatility, but not getting the reward because of the concentration. But I think because you're entering in retirement, the greatest problem right now is that your current allocation does not provide liquidity during down markets. Remember, we showed you that there's going to be this volatility. And there's the standard volatility that you're going to get over, let's say, 7 out of 10 years. But then there's those extremes in the every 4 years out of 100, so to speak, when you're really going to look at minus 22%, minus 38%. If you don't have sufficient liquidity, a place to go where you can withdraw consistently, because you're in retirement, you're going to have to withdraw consistently from your portfolio. When the market's down, you'll take what would be paper losses and you'll convert them into real losses because you're going to get out of something. The market's going to come back up and too late. You're not going to reap the rewards of the market going back up because you had to get out. We purposely designed our portfolios that we showed you, and again, the one you picked, 60% allocation to stock. But you'll notice that the bond component is being broken down 19% in long-term bonds, 19% in short-term bonds, and 1% in cash equivalents, CDs, treasuries, that sort of thing. Your current portfolio, it's got 0% really in the short term, it's got 7% long term. Here's the problem. You need to withdraw roughly 5% per year. That's the durable retirement income that you need. That's what the modeling shows, the retirement plan shows. So we want to grow the portfolio. We want to achieve that average annual rate of return of about 7%. But we want to also provide roughly 5% cash income to you. This is the durable retirement income that you need. Well, if the market goes down and you stay in your current allocation, that 92% in broad stock is going to be down. And if it happens to occur at a time when interest rates have gone up, or the bond market is struggling, that 7% in the bond allocation is going to be off as well. You've got where? 1% in cash to meet your 5% need. You're going to have to tap into one of the other two categories that are down. Our design for you is got 19%. Now let's kind of round that up a little bit. You need 5% per year, and we're putting 20% in short-term bonds and cash. You can withstand a 4-year period of time of the markets being down while still being able to withdraw consistently that income, that retirement income that you need, and not sell off other parts of the portfolio during a down market. This is the purposeful structure that we bring. This is how you take a portfolio and design it not just for growth, not just for a balance between risk and reward in where you feel comfortable, but also for this particular phase of life where you need durable, dependable retirement income. So to kind of sum this all up, the recommendations: you need to adjust your investment allocation to match the risk tolerance. You're uncomfortable with accepting more risk than necessary. You've got to adjust this from an allocation of 92 broad stock to 60% broad stock. Stop trying to time the markets. You're hurting performance. You're taking the full risk of the equity markets, but you're not getting the return of them. Don't try to pick asset categories, large versus small versus international versus bond. Don't try to pick market segments, financial versus durables versus consumer cyclicals. Broaden the equity exposure to diversify across asset categories and market segments. Your 60% allocation to stock should maintain an optimized exposure to large growth, large value, small cap, international, and real estate. And you should maintain it. Your stock allocation should also include a consistent, diversified exposure to the appropriate market sectors. Whether we use the S&P 500 or some other broad measure, but there's a certain amount you should have in financials, in consumer durables, etc., and then keep it. So you won't have to figure out what's going to be the next best sector to be in. You also want to allocate the broad bond exposure to provide sufficient liquidity. It's not just enough to be, 7% where you are in bonds right now, or even if to put the full 40% in long-term bonds, that's where your desired portfolio is. You need to be conscious about saying, I need a place that gives me a cushion that provides the liquidity. So you have to make that decision as well. As you make these changes, as you implement this, you can do it immediately in the tax-deferred account. So IRAs, Roths, SEPs, 401ks, 403bs, those sorts of plans, because there are no tax consequences to doing it. You can sell off and buy and be right at your desired portfolio, and there won't be a tax bill to pay. In the taxable accounts, so that's either a trust account, joint account that you got, any individual accounts, and a few in there. But those, when you make a change, if there's a capital gain, you're going to trigger a capital gain, and there's going to be a capital gains tax. And there are significant embedded capital gains in the taxable accounts. You've had Amazon for enough time and some others that there are some pretty large gains. But you do have the opportunity to manage the capital gains you actually have, capital gain tax that you pay over time by doing this gradually, not making this move all at once, but not delaying for some perfect time. There will never be a perfect time, at least never a perfect time that you can see going forward. It's always in the rearview mirror. Oh, hey, last week that would have been great. Well, it's too late when that's what occurs. So what you want to do is you want to do this purposefully over time, managing over time what those gains are, and take advantage of market downturns to harvest tax losses. Remember, in any given year, you can offset capital gains with capital losses. So if you're partway down the process and the market takes a sudden drop, well, you could sell out and buy back in, as long as you're buying a different security, purposely take the loss for tax purposes, but not run the risk of having a real loss for performance. And that tax loss will offset the tax gains that you have to take as you're going through this process of purposely adjusting the portfolio. We also recommend that you use professional management to implement the investment plan. Look, whether you take a passive approach using index funds or you take an active management approach, it requires professionals. Believe it or not, there are professionals out there whose title, whose education is that of money manager. They're not brokers or advisors claiming to be money managers. You need to use them. They, through the funds that they manage, will make the decisions what to buy, when to buy it, what to sell, and when to sell it in order to maintain the right diversification for you. Utilize them. Don't rely on someone whose job is to sell product, job is to pitch their crystal ball to actually manage money. Once it's implemented, or as you're going through the implementation process, you want to monitor performance regularly against the stated goals. This is what gives you the accountability and ensures the success of a retirement plan and the availability of that dependable income. If you set a goal, you ought to be on a regular, quarterly, semi-annual, at the bare minimum, looking and saying, what was the performance relative to the goal? What is the allocation? What's the breakdown within the asset categories and within the sectors? And is that being maintained consistently? Because it is that consistent allocation which is going to drive both the return, collar the risk, and provide for the durable retirement income. That's how we do it. That's the way it needs to be done, especially in this phase of life. So if we can help you, feel free to give us a call, send us an email. Let's schedule a consultation, free, of course, no charge, but let's take a look at how we can help you generate and maintain retirable, durable income in retirement.